Does the SUD Life International Wealth Creator Plan truly open doors to global wealth creation, or does it simply package standard ULIP features with an international tag? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So, this is an unit-linked life insurance plan, and some of the key features of the policy are: there are no policy administration charges, and there is flexibility to extend the policy term. There is a choice of 5 international funds for investment, no premium allocation charges, so your entire premium is invested in funds of your choice, and you get access to international equity and commodity markets for potential wealth creation. And you have the option to choose the debt sum assured multiple, and there are benefits like death benefit and maturity benefit. But as a unit linked policy, there are charges that they deduct from your premium, like fund management charges, surrender charges, switching charges, partial withdrawal charges, and mortality charges. So these charges act as an additional burden on the investor, unlike direct international investments where such costs do not exist. So as a result, they eat into your net investment and ultimately reduce the final corpus you can accumulate. And some of the advantages of investing in it are: the premium amount can be reduced at any time during the policy term, and also your flexibility to increase or decrease the premium payment term in multiples of 1 year are available, and policy term can be extended in multiples of 1 year up to the maturity date, and there is an option for premium redirection and fund switching as per the policyholder's preference. Settlement option is also available for both death and maturity benefits. However, the disadvantages are: no partial withdrawals permitted during the first 2 policy years, high charges which reduce overall returns, no policy loan facility available, and inadequate sum assured, leaving gaps in protection. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. So now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis to help us make a more informed decision. But if you do want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So here, for calculation purpose, let us assume that a 35-year-old male has purchased the policy with a sum assured of 11,000 rupees, and the policy term is 20 years, and the premium paying term is 20 years with an annual premium of 10,000. So if he continues paying premiums regularly, the maturity benefit will be the fund value. So based on the policy brochure's example scenario, the assumed future investment returns are 4 and 8% per annum. It is important to note that these are example rate, not guaranteed rate. This is just to show you how this policy can perform at worst and best case scenarios. At 4% return, the projected fund value is 2.46 lakh with an IRR of 1.96% as per the policy's maturity calculator. At 8% return, the projected fund value is 3.84 lakhs with an IRR of 5.88% as per the policy's maturity calculator. So when compared to the risk involved, these returns appear underwhelming. Investors generally expect equity-linked products to deliver higher returns or alpha that comfortably outpace inflation over the long term. However, in this case, the returns are closer to what one might earn from debt instruments, making it difficult to justify this plan as a true equity investment option within a portfolio. Since the IRR analysis makes it clear that the risk-return trade-off in this policy is not attractive, let us explore an alternative strategy in the comparative analysis just to see whether this alternative strategy can potentially deliver us with better returns. So one such option is the equity mutual fund international category. This avenue also provides exposure to international markets similar to what the SUD life plan claims to offer, but with greater efficiency and flexibility. So what is an international equity fund? An international equity mutual fund invests your money in stocks of companies outside India. Example, instead of investing in Infosys or Reliance, these funds may allocate to Apple, Google, Tesla, Amazon, Microsoft, or even companies listed in markets such as the US, Europe, or Japan. So essentially, it allows you to own a share of global giants without the need to open an international trading account. So international equity funds give you the exposure to foreign stock markets. While they do carry a higher risk due to stock market volatility and currency fluctuation, transactions, they also provide global diversification, access to world-leading companies, and potential for higher returns compared to ULIP. So what is the final verdict then? Is investing in the SUD Life International Wealth Creator Plan worth it or not? So this policy is positioned as a market-linked product, but its returns are far from convincing. While it does provide access to global markets, this feature doesn't create much value because the net returns are too low for a long-term investment. The primary reason for the underperformance lies in its high charges, and it also has a high agent commission. So international mutual funds are better than ULIPs for global investing. Like lower charges is equal to higher returns. Liquidity and flexibility is no lock-in period, and also transparency in cost and returns, and it is a focused product, which means pure investment. Insurance should be separate through a term plan, and it gives you better suitability for goal planning like easy entry and exit, SIP option, SWP option in retirement, like this. So if your goal is to invest in global companies and diversify, go for international equity mutual funds directly. And if your goal is life insurance protection, buy a pure term insurance policy where you can get a higher coverage even for an affordable premium. But mixing both in a ULIP usually means you get average insurance plus below average returns.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.